Okay, the rest of the Subpart F code sections are listed up there. And what we'll do is talk a little bit about Section 959. We'll also use Section 960 to demonstrate one aspect of how Subpart F works. And then we'll, I think, pretty much ignore the rest during our discussions. Please do look through what's on the slides, because again, the slides are meant to be a reference tool for you as well. And I certainly recommend, especially on the calculation of E&P, that you at least scan through Reg Section 1.964-1, which gives you a step-by-step procedure of how to calculate E&P of a foreign corporation. And it's something that it's good to know about and know where to go if you need it. But in talking about 959, we'll talk about why it's there and what it's meant to accomplish, and then we'll move on to the next part of Subpart F that we want to talk about. Okay, so our concern now is with 959. Now, let's say that we have the usual U.S. parent, and let's say it has a CFC. And let's assume that this CFC does in fact have some foreign-based company income. And again, that could be foreign personal holding company income, foreign-based company sales income, services income. And let's say that as a result of having this, let's say 100, that there is a 951 inclusion, A1A, inclusion in the income of the U.S. shareholder. So it includes in its income 100 and pays tax on that 100, even though there is no actual dividend paid. We'll assume that there is no foreign tax at the CFC level for simplicity, and no withholding taxes also when dividends are paid. Now, clearly, you could have a situation where, for example, in 1 year, let's say year 1, this is the situation. That there's this 100 of foreign-based company income and 100 of taxed at the U.S. shareholder level. Let's say, though, that in year 2, there's 0 of foreign-based company income, but 100 of other earnings during the year that are not Subpart F income, do not cause a inclusion by the shareholder of income. And let's say that after that, we now have 200 of accumulated earnings down at the subsidiary level. At the CFC level, we have 200 of earnings. Let's say that the CFC makes an actual distribution. In other words, goes and declares, goes through the legal procedure to declare a dividend of 100. So we have a dividend, an actual dividend of 100. Well, this is really an ordering rule. When there's an actual dividend of 100, out of which earnings and profits down at the CFC level is it paid? Pardon?
First current and then accumulated.
Well, there's that basic rule in the domestic context, but is that what we have in Subpart F? If we take the current year first and then go back, let's take what you've suggested and see what the answer is. We've said that year 2, it was non-Subpart F income. So if it's a case of the most recent year first, then that means that the distribution of that 100 is out of the year 2 earnings, which were not Subpart F income, were not already taxed at the U.S. shareholder level. So that would mean that in year 2, our shareholder also has another 100 of income from that actual dividend. Now, I don't think there's a question of what's fair or what's not fair. Congress made a decision when Subpart F was enacted that we will not use that normal rule. Rather, we will allow any actual distribution to first be considered to be paid out of this 100, which has already been included up here. They made a decision to do it this way.
Is it the first in, first out?
Well, it's actually not first in, first out, or last in, first out. It's neither, because you might have a series of 5 years, and some years there's Subpart F income that's recognized at the shareholder level. In other years, it's not. So it's no longer a year-by-year thing. It's rather first go to amounts that have been included in the shareholder's income. So as a result of this rule, because the actual dividend is considered to have been paid out of this one, when that dividend is paid, it is not considered to be a dividend and is not income at the U.S. shareholder level. It's a very kind approach to doing this. They didn't have to do it this way, but this is what they did. So to the extent that you have a Subpart F inclusion in income, future actual distributions will be considered to be actual payments of that amount. Yes, Peter?
So is it that they're excluded from income? Is that
Effectively, yeah. They're just considered non-taxable. I mean, look at the language in 959 and see exactly what it says. It's a very long and convoluted sentence, but if you read through it, it essentially says actual distributions, when distributed, will not be taxable, will not be treated as a dividend. Yes, Glenn?
So this is really individual. So depending on when a U.S. shareholder became a U.S. shareholder, results might differ among U.S. shareholders.
That's a good question. If I remember correctly, the way the rules work, I believe there are provisions in the regulation. I'd have to look back to be sure, but I'm relatively confident. There's provisions in the regulation that if a new shareholder acquires shares which the old shareholder recognized income for, I believe that that does carry over. I believe there's something on that. I may be mixing this up with something else, but I don't think so. There's a certain amount of sense to it because if a shareholder, but you've got two possibilities. One is that a new shareholder buys the shares of a U.S. shareholder who's selling. The second is that the new U.S. shareholder buys from a non-U.S. person, or alternatively from a less than 10% U.S. person. And I think you'll get different answers in each case. There's some symmetry here because the selling shareholder is going to receive, is going to have to recognize income, but to the extent he doesn't get the cash, he also gets an increase in basis of his shares. So he'll have less gain when he sells. But there's still those earnings inside the company which have already been taxed to somebody. And the U.S. system in its symmetry normally doesn't tax the same item twice. So I'm pretty sure it's there. If you look for it and don't find it, let me know and I'll take a look. Okay, so this is 959. It's basically if you've had to include something in income, the U.S. shareholder, when the next payment, actual distribution is made, you're not going to have to recount it. And I think we had a question, maybe it was from you, Glenn, a week or so ago, in terms of what if you have a distribution in the same year? What's the order of things? And again, you calculate income under Subpart F first, and the distribution even out of the same year will then come under 959 and not be taxable. So Subpart F income is applied first, the inclusion in income under 951, and then the actual distribution is dealt with. So there's that ordering. Does that make a difference? Well, it can. We've mentioned before the special 15% tax rate for individual shareholders of qualified dividends. Well, it's got to be a dividend in order to come under that provision. And an inclusion under 951 is not a dividend. So 35% rate would apply, not the 15% rate for an individual shareholder. So yes, that can make a difference.